Welcome to Season 2 of the Generational Dental Wealth Show. Season 2 is all about increasing dental financial IQ. We do record these live in studio at Team Studios, so if you want to see the video format of this show, go ahead to Spotify or YouTube. Let's hop into it. What's up, Dental Wealth community? This is part 2 of a great episode I had with the Truth Be Told podcast with Dr. Leroy Horton and Dr. Walter Acker. Man, I really think you'll get great value out of this episode here. We talked all things taxes, making sure you have what you need as a dental professional. So go ahead and tune in. Like I said, it's going to be an exciting one. I'll see you on the other side.
What is the biggest mistake people make when they're 1099s when it comes to quarterly and all that stuff? If you can go in depth with that.
What ends up happening a lot of times, like I said, especially for those ones, professionals that are, first year, second year, third year, 1099, they're switching over from W-2. The biggest mistake they have or that they make is that, well, let's start here. They don't record keep. People are like, I'm 1099, I'm good, I'm still going to different offices, I'm not a business owner. In the IRS's eyes, you don't have to have an LLC to be a business owner. The moment that you engage in a trade or an activity for a profit, you are a business owner, even if it's you doing haircuts. You don't need an LLC. The IRS treats you as a business owner. So long story short, they get the tax time, they get that 1099, and it says $200,000, and they're like, yo, I made a lot of money this year. Then they have no records, and they didn't do any bookkeeping to see what were their expenses. And so all of the miles that they drove, right, you can write off, the home office that they might have had, the lab coats, the different things that they needed to go do those jobs, they didn't account for. They mixed it in with their personal account. So it come tax time, they're paying taxes on a whole $200,000, which if they were just thinking about it throughout the year, even if they hired, even if they did it themselves, right? At that point, you as a 1099, you could probably figure it out, doing your books yourself. You might have had, $80,000 in expenses, right? But because you didn't record keep throughout the year, you have no backup to kind of prove that. Even if you did do it, you have no evidence, right? It's kind of like guilty until proven innocent, almost. And so that's what I see a lot of times is, business 1099 contractors, locum tenens, they don't think of themselves as business owners yet, because they don't have a practice sometimes, and they kind of think that they're still an employee, in which tax time is just totally different.
Right. So if you are a 1099, and let's say we've listened to your advice and we're record keeping through the year, do you have a rule of thumb, depending on your projected income, of how much money you should be setting aside every check? Is it 15%, 20%? What do you think is a good kind of standardized playbook until you figure out what's a good number for you?
So I always like to say 25%. I mean, that's probably a little bit overkill, but you'd rather overkill it and have a little bit left over at the end of the year to go during Christmas time, or because you don't want to undershoot it, right? And only withhold, let's say 10%, and now you're having to scramble to figure out how you're going to come up with the rest. So there are a few ways for us to calculate that. Typically, most CPAs, especially dental CPAs, they should be giving you some type of tax projection come November, so that you can know what's coming down the road. You don't want to get to January and realize that you got to come up with 40,000. I've had those conversations, unfortunately, because people have come just extremely late, but they don't have that $40,000 on hand, and now they have to go get a payment plan with the IRS, and now interest and penalties and all this unnecessary things that they could have avoided. So 25%, like if you had nothing else to base it off, I like 25%. Obviously, like we said, it just depending on what your income and your tax brackets, but 25% I think is a good baseline.
Okay. Now, are 1099s required to pay quarterly as well, like business owners are, or is that only once you are an LLC?
Yeah. He's shaking his head. Exactly. So 1099s in the IRS eyes are business owners, right? They are LLCs incorporated 1099. All these are synonymous for business owners in the IRS eyes. And so, for example, whether you have an LLC or not, whether you just 1099, you still get the same tax benefits as a business owner. So you still have the same tax requirements as a business owner. So long story short, quarterly tax payments are typically due as well, as a 1099 contractor, which is obviously a misconception out there.
Yeah,
So
absolutely.
here's the thing. So now we're progressing, right? I'm still trying to tell a story here. We're progressing. Now we've done so well. We've been excited. We've done 1099. We've traveled. We've done everything.
Yep.
Finally, you tell us you can go get your own dental practice, and we're like, yes. In Leroy's case, he gets like 10 of them. But we're talking about a normal person, right? we get one, and we're happy. When do you jump in, right? Because if it was up to us, we would go to the bank and we would get like a million, 1.5, and be like, cool, thank you for that check, because the bank is going to give it to us because they realize that the dental practice, the failure rate is very low. When do you come in and say, well, pause, we need to really look to see what you need and what you want? And how
Yep.
does an accountant or a CPA kind of guide a dentist through that process?
Well, before you answer that, just to make things clear, do you, as a prospective buyer, choose how much of a loan you want, or is there an equation that dictates how much you can actually qualify for?
Yeah.
Okay.
So typically banks are going to loan you up to the purchase price of, and we're assuming that you're purchasing a practice, right?
Yeah,
Or
we'll just do
yeah.
that one. Yeah, that makes it
Okay,
easier. Yeah.
right. They're going to loan you typically that purchase price of practice, and then typically some type of working capital.
Mhm.
And I actually do see a lot of dental transitions, right? You're typically going to be buying the equipment from the previous practice owner. Typically going to be buying the patient records. You're typically going to be buying the accounts receivable at a percentage. Typically going to be having some type of I don't want to call it non-compete, like kind of like a non-compete, saying, hey, old dentist, you can't come back and try to take all the patients that you just sold me. Right. So you're going to be buying all of these different assets, and the bank is going to look at that. You're going to look at your LOI. They're going to look at all of the different documents that you have with the prospective seller. And they're going to say, okay, let's take a look at this. And then they're going to give you, right, working capital on top of that price, right? Working capital meaning extra money that you need to pretty much get off the road and get going. So they're not just going to be like, okay, Dr. So-and-so needs 2 million, even though the practice is only 1 million and they only need, maybe 45,000 of working capital, right? You can't just go and just start
Make up a number, right?
Exactly. Exactly.
Yeah.
No, it has to have some type of backing. Yeah.
Okay.
And
Now,
so,
if
go
you can
ahead.
tell us the difference between, if I'm buying a practice from Walt, I may want it allocated as assets.
Yeah.
He may want it allocated as goodwill. And I
Right.
know that a lot of practice, prospective buyers are going to be hearing that. Which one is, or what are these two, and who are they beneficial to?
Right. Yeah. Explain that first, and then.
Yeah. Man, we're gonna leave here today with
With a master's, yeah.
masters.
Well, listen. We're not gonna do that.
Yeah.
Please go see a proper CPA. We are not
Yeah.
gonna. Don't do anything on your own, please. We're actually doing all this because it's very complicated, as you can hear.
Yeah, exactly. So, typically the seller is going to want to have as much allocated to goodwill as possible, and then the buyer is going to want as little allocated to goodwill as possible. And all goodwill, trying to just make a complex, I guess, thing simple will be whenever the seller is selling a dental practice. Let's say they're selling it for $1 million. All of the equipment, patient records, et cetera, accounts receivable, right, from the practice. Let's say that's all valued at $400,000. There has to be something else that makes up that $600,000 that's not the assets that you're essentially purchasing. So those are the things that we call goodwill, something that you can explain, right? We like to kind of attach it to maybe, okay, this dentist has built a good reputation in the community, and people know where the office is. They've been around for 30 years. We just call it goodwill, like it's the amount above all the assets that you're buying. Now, the reason that the buyer does not want, the reason the buyer wants as little as possible to be quote unquote goodwill is because goodwill typically has to be amortized over a 10-year period. So amortization is pretty much the same thing as depreciation, just for an intangible asset. Intangible assets meaning like copyrights, wills, non-competes, goodwill. I think I just said goodwill. Those things that are intangible, but they're still assets that you have. So as a buyer, I would like everything to be not goodwill so that I can pretty much write off everything that I just purchased early. year one, year two, year three, because equipment typically, right? Let's just say we can allocate that whole $1 million purchase price to equipment, right? Let's say we value and do some different things, and it's all that means that equipment now we can depreciate it over 5 years instead of 10 years if we allocated all to goodwill. And so the opposite is true for the seller, because if the seller go ahead and allocate as much as possible to goodwill, right? The pretty much their tax consequences or the tax burden of the transaction will be a little bit more kinder. Without going into too much, right? It's like the capital gains rate, which is like the favorable rate versus the normal. Anyways, like I said, I just want to keep it there just to say, right? Typically, you do want to have a conversation with your CPA before you purchase the practice to see what that allocation and split will be between hard assets and then goodwill.
Okay.
Yep.
Okay. See, and again, this is why we say, please go see somebody who knows what they're doing.
Yeah,
I get it. TikTok is nice and you get little clicks here and there, but some of the stuff that they say, I am like, what? That doesn't make any sense. Or I'll contact my CPA and he's like, no, you can't do that. I'm like, okay, thank you. You know what I mean? I look stupid, but I'm like, I'm doing it for a reason. I want to make sure people who are younger don't come in and think that they can write off all this stuff. And, oh, I bought this cell phone and I'm writing it off. And I bought new Jordans and I'm writing that off. Like you got to be smart. You got to ask the right questions, Okay, let's keep going. Let's go ahead, please.
And one thing I just want to throw in there,
please.
As you said, that kind of reminded me, that's why I truly believe, right? It's important to have a dental specific CPA, because whenever we're talking, it's just like specialties within dentistry. You might have a good idea and a good sense of the right answer, but until you've been in that situation enough times, a normal CPA won't really know dental practice transitions. They don't really know the ins and outs of the valuations. What are we doing? Is it EBITDA? Are we doing one-time collections? Because as a general CPA, and I'm gonna give you a quick example, we call collections revenue, right? And where, in practice, we typically call collections, and we call revenue typically production, right? It's just different terminology and just different approaches even though it's all the same, I guess, formulas, there's different languages and terminology. So dental specific CPA will be able to put it in the terminology and what dentists know by.
Okay.
Yep.
That's awesome. Okay. Yep. I'm going to ask you a question and you may not know this, right?
Yep.
But I just kind of talking to people, right? We have corporations and corporations are growing as we speak, right? And there are a lot of people who partner up with corporations.
Yep.
And the funny thing is they always say, oh, well, I use their CPA. And I always think to myself, why would you use their CPA? Because their CPA is going to make sure that they're good financially. They're not going to look out for you. They're going to just make sure that the corporation is good, right? So what advice would you give to somebody who partners up with a corporation and then says, I'm going to use it? Would you still say, hey, no, go find your own CPA, especially a dental specific CPA, to look over all the paperwork and everything that...
Right. Are CPAs objective, or are they like lawyers where they represent clients?
Okay.
Yeah. Okay. To be fair, I think in that situation, accountants are typically a little bit more objective, meaning that they don't have a dog in the fight because it's not a negotiation.
Okay.
It's not a negotiation type of relationship. Now, one thing that I would say is, me as a dental professional, why would I go and let's say I'm making $300,000, I'm doing pretty good. Why would I go and now try to get the same CPA of somebody who's, doing a 50 office practice, maybe a small DSO, something like that, that's doing, $80 million, right? The problems that 50 office practice has, and then your $300,000, and there's no knock, right? But these are just two different strategies and two different formations, two different structures, that they would be looking at. Not saying that they wouldn't know how to handle, your tax situation, but they may not have, I would say, the capacity, because they may be dealing with these huge, bigger clients to specifically identify you and your pain points, right? And it might become kind of like you're just another number in the toolbox. versus that CPA that just deals with, dental professionals that can kind of identify and work with your specific situation. So there's no knock. I'm sure, those accountants are still great and still do a great job. But I guess me as a dental professional, I'll be thinking, will I still get that, I guess, concierge level service, even though I'm, a little bit small on the totem pole compared to those big 50 office practices.
Okay. But now, we're at the point where we're buying an office. We went to the bank, we're getting our loan. And I'm going to liken it for anyone that's non-dental that's watching this. It's like you go and you get a car, right? You can get a favorable loan. You can get your 15-year adjustable arm loan on an automobile. Like there's outrageous loan structures out there.
Yeah.
What can you give us just a basic framework for a good, healthy, fair loan that someone should be seeking? Obviously, if they can get better, they'll take the better option. But what traps have you seen as far as dental financing that a young doc could fall into?
So, it's actually funny enough. I've lately been working with a lot of different dental practice transactions. And one thing I find is whenever you use the word evaluation, it's a fancy word for estimate, right? There's what I put on evaluation for, let's just say, I'm coming in and I'm buying this art piece that's in your house, in your home office, versus what somebody else. I might not be an expert. This guy might come in and say, hey, no, this is actually worth $20,000. And me not knowing, I'm like, this looks like splatter on the wall. Doesn't really mean like anything. I'll give you $200 for it. So when it comes to valuations are very subjective, meaning that when you go and when you purchase a dental practice, when it comes to that loan, you really make and lose your money on the way in. Meaning if the previous dental practice owner has their practice listed for $1 million, don't take that as face value. Once you're in the due diligence process and you're getting more serious about this deal, it may be worth taking it to a dental transitions expert and saying, is this deal really worth $1 million? Because when you get that $1 million loan, you're paying interest on that, right? You have a big obligation versus, you might come back and they're looking at the previous owner's tax returns. They're looking at their financials and they're saying, it wouldn't make sense to pay more than $800,000 for this, right? So I haven't found that, banks or anything are malicious and giving out any sharp loans or anything like of that nature. But I would say when you go in and you overpay, that the loan is bigger, right? And now you just end up getting into a situation where, you could have mitigated if you just had a second opinion and say, what is this practice actually evaluated at, right? And why?
Okay. I've actually, in my experience, have found that the banks can often serve the buyer as a filter because the bank has to justify that the amount you're asking for is justified by what you're purchasing. Mm-hmm. So they'll look at the valuations, they'll look at the assets, the tax returns, because they're invested in you actually paying them back over that 5, 10, 15 years. I mean, you still want to have your own CPA, but I think what I've been seeing lately is either like initial interest only terms, right? Which for some people might work, but let's just stop there. Can you give us an explanation of what an interest only term is and why it might be good and why it might be bad?
So from my understanding, right, when it comes to any type of loan, you're going to have those two pieces, right? Interest, principal. Whenever you're talking about a loan, you typically, so I always call interest the cost of borrowing that amount, right? The cost of borrowing, meaning that if you're paying interest, that principal balance is not changing, meaning you're not technically even paying down your loan. You're really just paying the cost of having the loan. You're not really decreasing the value of the loan itself. So in certain situations, right, if that is the case, you're really just I would say just running in place, right? You're not really making any progress towards that principal balance. Now on the flip side, I've honestly seen some, especially when you talk about dental specific banks, I've actually seen to where they will allow you to pay principal for a certain amount, so they'll actually forego interest for a certain amount to where those first few payments can just be you get down that balance. So, when it comes to banks, and obviously I'm not on the finance, your CPA, may have to call in your banker to discuss some of these things. But different banks have different, I would say rule of thumbs around their philosophy with lending. Yeah.
Okay. Well, let's wrap it up here by kind of getting your overall thesis for a dentist, right? I mean, good or bad, and hopefully it's good. But after working with us for so long, what are the biggest mistakes that we make as coming to you, right? If it's bankruptcy, if it's overestimating what we can do with our money, whatever it may be, what are some of the issues that you've noticed, and what are some of the things that we need to do better with?
If I was to put it in one sentence, trying to out earn the problems. Um, I always say, money doesn't solve money problems.
Mm.
I deal with clients where they're making a lot of income per year, but they're falling behind on their debt. They're falling behind on their tax obligations. They're falling behind on, and it's like, I want to keep making more to keep servicing these problems. But in reality, right, it's like you're never really stopping and bleeding. You're really just putting a band-aid over the bullet wound. And you're just delaying the honestly inevitable. So that'd be number one, right? That you really want to put things into place to where you're not just trying to make more. Sometimes it's about keeping more. And those are equally as good strategies. So that I would say that's probably the number one thing. And then the number two thing, I think, when it comes to finances, right, and especially, for, obviously dentists, right, go to undergrad. Some of them do something after undergrad. They go 4 more years. Maybe they specialize, right? They get all these years of, education, which is great. But honestly, throughout those years, you don't really learn too much about how to, navigate the financial part. So it's one of those things where it's, don't think that it makes you less of a professional to say, hey, let me go talk to somebody about, this part of my finances, right? It doesn't make you any less smart. It doesn't make you any less of a doctor. Because at the end of the day, if Elon Musk and Donald Trump and all these guys have accountants, and these are, guys that are making millions of times of what, the average person is making, if they have, teams of accountants, why can't you have a CPA on your side? So,
Yeah, that's a good point. I did have one last question on my end, man, is because I know we talked about generational wealth before we started recording. How is it that, let's say I buy an office, I invest all these years, and it's profitable, I make money, it's worth something by the time I'm ready to retire. If none of my kids are dentists and can take this over, can you explain or tie in how that can still be generational wealth if what I have to do is sell this to someone else? And because a lot of times these terms make it sound like, oh, well, yeah, it's generational. You pass it down to your kids. But in most states, you can't own a dental office if you're not a licensed dentist, right? So how can we transition what we own as a dental office to actually be, or to be considered, generational wealth?
Yeah, exactly. So to your point, over your 35-year career, you spent building this essential, asset, right? It's giving you income each year, but ultimately, right, you're building patient lists. Ultimately, you're building a good rapport in the community. You're buying this dental equipment. So you have this physical bundle of money, essentially, that we call an asset, right? It's just in a different form of cash, right? That equipment or that goodwill just in a different form of cash. But you have that when it's all said and done, you're ready to exit, you're ready to retire. So not only, could you go and sell that, but, what you can also do is pretty much figure out ways that you can roll that over into other generational assets, right? Because just because you're out of dentistry and you have this lump sum of $1 million doesn't mean that your generational wealth journey ends, right? There are ways that you can roll that into maybe different accounts for your kids, and that's more so going down the finance end. But there's a lot of strategy when it comes to that, and when it comes to the end of your practice days, man.
Perfect. Can you please tell us, how do we get a hold of you? If anybody's interested in having your services, they don't necessarily have to be in North Carolina, correct?
No. So we do service clients 50 states virtually.
Perfect. So how did they get a hold of you? How did they get your services? How did they ask you questions? If we didn't ask enough questions and they still have something, how did they get a hold of you, please?
Yeah, so the best place is Instagram, Kingsley Ifedi, just like my name. I keep it really simple, and also LinkedIn. I'm really active on. Same thing, Kingsley Ifedi. Now, if you really want to get really extravagant with it, you can always find us, every Tuesday with the Generational Dental Wealth podcast as well. And we do sometimes, some episodes, we do take live questions as well, in which we do try to hear from what people are thinking. So either of those three avenues will works for me.
That's awesome. That is awesome.
I'll tell you
Sir?
what, man, we've all been blessed with your knowledge and expertise. And if nothing else, even if no one's going to walk away remembering every single detail of what we spoke about, to at least walk away knowing that, hey, when you start making money, get a money expert, get a numbers expert on your team to protect you, sometimes from yourself, and the money that you're going to be making, so it can be generational and it's not burning holes in your pocket.
Exactly.
That's awesome, man. Well, thank you, sir. Really appreciate your time. Honestly, this has been awesome. You've helped. I can guarantee you've helped a lot of people, and you basically put some knowledge into people that maybe Instagram did not do, or TikTok, or whatever it may be. This is real information, people. I just want to let everybody know that.
And that's it for part 2.
So really
go ahead and show my guys Real Tooth Be Told podcast some love. Follow them on Instagram at Real Tooth Be Told. Can't wait to see you next week.